They made it a long way back because, like you said, it was down 548 points at the lows. And as the day progressed yesterday, I remember sitting there either on the markets desk, on our news desk, or with Power Lunch or everybody else watching this move higher. And a lot of the concern was whether or not we would see a lot of volume.
Off the lows?
Yes, off the lows. Off the lows. Yes, they are very much not higher, but off the lows. The curious part about it was a lot of the volume that we saw during the day was very front stacked during that sell-off portion. And so traders look at things called volume-weighted average prices, something they call VWAP, and it indicated that most of the selling pressure happened in the beginning. But if you are looking for places where people either found that deep value trade, trying to buy off the lows, or tried to cover some winning bets on the short side of things, it is places that have seen the most weakness so far. We looked at the S&P 500, looked at all the stocks that made the biggest moves from their intraday lows to the highs, and it turns out about on a percentage basis, 27 stocks in the S&P 500, guys, moved 5% or more off of their lows to their highs. I'm going to give you a sample of them right now. One of them is a name we all know. It is Netflix. Those shares moved rapidly to the upside throughout the course of the day, as you can see there from that chart. That right-hand side is what we saw intraday, and we saw a move higher there with Netflix. Another one to watch is on the transportation side. You guys mentioned UPS, but one of the airlines out there that's been hit really hard, unlike United Continental, you have American Airlines on the other side. That stock was down big throughout the course of this year-to-date period, and you can see there on that right-hand side a huge move off the lows. Another one to watch here, regional banks. Interest rates a huge focus here. Many of these regional banks, you look at Fifth Third, it was an earnings-driven catalyst. However, Fifth Third is one of those regional banks that still is down year-to-date and caught a bit off those lows. And the other one that we want to kind of take a look at as well is the home builder side of things. We've made a lot of hay with the idea that home builders have been in a downtrend for a while. If you look at Pulte Group, one of those home builders driven off a solid earnings report, but maybe it was short covering to a certain degree. Or maybe people did feel as though this was a low enough point to buy. The point, if you look at that chart, though, for Pulte, is that if you took a short position earlier on, 9 months ago, 10 months ago, you're winning. And maybe that was a catalyst for you to kind of get in there and cover some of those winning bets. So it's not to say that everything was short covering, but it certainly feels as though many places in the market that caught the biggest bid were the ones that you could have seen downtrends for a while play out, and then people say, hey, this is a good enough time for me to cover some of those.
And that's one of the quibbles, I think, with the rally is just that, well, of course, kind of the junk bounced, and we don't know if it's more than that right now. The other one is just not a lot of climactic feeling panic or anything. It was a very methodical comeback, right? It was just kind of like selling dried up, and it just kind of lifted throughout the day. So I think there's also a watched pot problem. I mean, we're all talking about a successful retest before it happens, and everyone kind of wants to call it. And so you just never know if that's self-fulfilling or if that's just a head fake.
Right. One statistic I'd seen is that for the last 3 weeks, retail investors have been the buyers. It's been the hedge funds and the institutional investors that have been stepping out. So who's the smart money here?
Well, it's also, we focus so much
because I wouldn't necessarily call hedge funds smart money with some of the returns they've seen.
But what I would look at is the real money, and that is the mutual fund or ETF type managers out there, because they're driven on flows. A mutual fund manager, typically, if they're sticking to their investment mandate, will invest money or buy stocks when they have client inflows in, and they have to put that money to work. So whether or not you have asset managers like a Fidelity or a T. Rowe or a Vanguard put money to work, and that's driving up prices, or whether or not it really is just hedge fund traffic that's kind of driving some of the action.